Hey everybody, how you doing? It's Uncle Bruce here. Welcome to my class number 2, how to write options on calls and puts, how to write stock options. Welcome everyone to the class. I'm glad you could make it. Nice to have you here. We're going to talk about how you can make some extra money in your account on stock you probably already have. And we're going to talk about how this works, how you do it, some of the different strategies on how this is going to get done. I'll try to explain it as best I can. Jen is going to be watching the show, and she's going to be acting as a moderator for your questions. Those of you who are here for the first lesson, you kind of know what the routine is. Uncle Bruce desperately tries to write on a whiteboard with terrible penmanship. And then Jen keeps an eye on the comments, and anytime you have questions or from time to time, she'll interrupt me and say, would you mind explaining that a little more clearly, or would you mind saying this or saying that? So thank you everybody for being here today with me for how to write stock options. All right, so let me grab a marker and take the cap off and put the cap down on the table so it won't fall onto the floor like it did yesterday. And let's talk about writing stock options. All right, so this is actually a conservative strategy in the options market. Doing this is actually a more conservative strategy than actually trying to buy call options on an open market. There's a lot of people out there that have a feeling that they have this notion that, oh, if I write stock options, I could lose my shares. Oh, this would be a disaster for me, and that's not true. Writing call options is a way, or writing put options is a way to bring in enhanced revenue into your account for shares you already own. Many of you have for years and years, some for months and months, depending on how long you've been an investor. You've been holding stocks in shares in companies that you believe are going to be more profitable and more successful as time goes on. And your idea of making money in the market is, well, buy the stock at one price, and then as it goes up, I'll sell it for a higher price, and there's my gain. Some of you are buying stocks like IBM and others that pay a dividend, and you've been collecting dividend income, hoping that maybe every quarter or every 6 months or once a year, the company will announce a dividend increase because the company is earning more money, and that the shares will go up in value over time, and the dividends will go up over time, and that's how you're going to make money. Where the entire time you've been doing this, there's been an opportunity waiting for you that you can take advantage of, which is called writing call options and or put options. And this is a way for you to enhance revenue to your account. In effect, what you're saying to the market is, under the right terms and conditions, if you give me enough money, I'll give you a shot at buying my stock from me, from my account, at a certain price that I'm going to determine, for a certain time frame that I'm going to determine, for a set dollar amount that between me and the market we're going to determine. And if you give me that money up front right now, I'll give you a certain amount of time with which you can take my stock away from me if you wish to. Would you like to play that little game? And there's a lot of option players out there going, oh yes, I would love to play the game because I want to leverage stock with options, and I need options to acquire. I need to buy options in order to do this. Hedge funds do this, pension funds do this, mutual funds do this all the time, where they have stock positions for their clients that they're trying to make money for, and they will offer and write stock options against shares they're holding for the long term to enhance revenue into the account, and for the benefit of pension fund participants, mutual fund unit holders, ETF holders, and that type of thing. There are hedge funds that are run by very sophisticated professional people who will have hundreds of millions of dollars into stocks like Apple, IBM, Google, Netflix, and any stock you can imagine, and they will write options against those shares to bring in income while they're hanging on to the stock for whatever gain they think they're looking for. If a pension fund is looking at a 100-year future, a 200-year future, because say the California Teachers Pension Fund, they're around forever. Firefighter pension funds are around forever. They invest for the long term, and they're very willing to hold stock in companies that continue to grow and get larger and larger and larger. They're willing to hold stock for a long, long time, and they're happy to write options to bring money in on top of the dividend they're bringing already. And if there's a capital gain long term, they're happy to get it. Okay, how can you benefit? Let's talk about a stock like GameStop. As an example, I'll also talk about some SPACs that we're watching and following as well to kind of give you an idea how this can work. All right. So on the GameStop shares, let me take a picture here. Let me take a peek at my big ass iPad over here, and I'm going to pop up the latest quote, the quote that we've had and where we're at on GameStop. Okay. So Friday in the evening, GameStop closed out on Friday at 191.23. All right. Now I'm going to write, I can put my cap back. Don't forget, don't drop that cap. All right. GameStop. Hang on. Let's talk about writing options and get rid of this right now. I need the whole board, kids. Okay. GME. All right, the closing price for the stock on Friday night, 191.48. I'm going to write it down as 191.50. That's where the stock closed at on Friday. This is July. Today's July 11th. This is July the 9th, okay? So July 9th, 21. This is where your GameStop closed at on Friday. Those of you who've been into GameStop since early this year, you know how the shares have gone from the $40 level to the $360 level, and even 400 odd, and up and down it goes. But right now it's at 191.50. You all know that the GameStop shares can go up and down in value. $10 a day, it can go higher. $10 a day, it can go lower. It can do both the same in one day. It can open at a low level, go to a high level, close back down again, can start high, go down, go back up. It can do anything. Options against GameStop have what we call a high dollar value. The volatility of GameStop being a stock that can really move. Contracts on GameStop have a very high premium, and the gamblers out there are willing to pay more money to gamble on GameStop shares than they would maybe on IBM shares or Apple shares, because Apple does not go up and down in price $15 a day on Apple stock. If it goes up a couple of bucks in a day or down a couple of bucks a day, that's significant. It's not uncommon where Apple or IBM or many other mature large corporations, their shares will only fluctuate a couple of dollars a day. This stock, we know, can really fluctuate a lot, which means the option players love it. They love the volatility. There are option players who are trying to buy contracts at $5 and sell them at $8 within the same day if possible, and make a bunch of money, or they'll sell options at $8 and buy them at $5 and make a bunch of money. You as an option writer cannot sell a call contract against GameStop unless you have at least 100 shares of stock in your account. You must own 100 shares of whatever stock you want to write options against first. You have to be long 100. So let's start with 100 shares right here of GameStop. 100 shares will allow you, or will equal one contract, one option contract. All right. So now, if you are a buyer of options, you buy a contract. You can you're playing with 100 shares. If you're a seller of a contract, you're selling one contract against every 100 shares you own. You own 1,000 shares. You could sell 1 to 10 contracts against your 1,000 shares. It's up to you. You don't have to sell, if you have 300 shares, you don't have to sell 3 contracts if you don't want to. You can literally sell one call contract that expires a week from now, one contract that expires 3 weeks from now, and one that expires 6 months from now. Totally up to you. But in the case of this example, we'll just go with 100 shares only of GameStop. That'll allow you to write one contract. And I'm going to talk at this moment about writing a call contract. Now, why would you write a call contract? A call contract is a call contract is a document, is a contract between buyer and seller where if you're offering your 100 shares on the market through a call contract, you are telling the buyer of this contract, whoever the buyer is in the open market, that they can have your stock at a set price for a certain period of time if they cough up money up front. And to take a look at the options market on Friday night, when we last traded on the exchange, if I wanted to write a relatively short-term contract, a contract that expires, say, at the end of this month, roughly, this being July, here's how this would work, just to give you an idea. There are call contracts existing for July. Every Friday these expire. There are contracts that expire every Friday for the next 2 years at least. There are contracts right now that expire July 30th, 2021. And on GameStop and any other stock that's out there, call contracts have a certain, what we call, strike price. There isn't just only one kind of contract or one price of a contract available on GameStop. There are multiple prices. And gamblers out there, investors who want to buy and sell call options and put options, they will shop around for the contract that they would like to gamble against or invest into. You as a call writer can pick the call contract you'd like to offer to the marketplace based on where the shares are, where you think they're headed between now and, in this case, July the 30th. Today is July the 11th. Okay, so this is Sunday. Tomorrow's the next trading day. Monday is our first trading day again, the 12th of July. So if you were to sell a call contract that expires on July the 30th, tomorrow, the 12th of July, the contract has 18 days left to live. All right. If I got my mathematics correct, just bear with me. All right. So today is tomorrow is July the 12th. That is Monday. All right. This contract dies on the 30th of July. So it'll trade Monday, Tuesday, Wednesday, Thursday, Friday next week. It'll trade the next 10 days after that. And as I say, we're going to go to the 19th and the 26th and then 4 more days. So it has 15 days of trading life left in it. 15 trading days. We don't trade Saturdays and Sundays. We only trade Monday to Friday. Contracts. How do I want to explain this the right way so you get this? Again, bear with me. I'm going to try to make this as simple as possible, as best I can. If you own the stock, you are a believer in GameStop. You believe the shares are going to go higher in price due to what Mr. Cohen is doing, the directors, the new officers of the company, all the things that are happening with GameStop. We're following GameStop because we like it, and we like the company. We like the prospects of the company. We think the shares will go higher. The question in our mind right now is how much higher will the shares go between Monday, tomorrow, and the end of this month, or when this contract expires on the 30th of this month? That is the question you have to ask yourself as a shareholder and as a possible creator of a call option, if you're going to create or sell a call option. What you want to do is you want to offer a call option into the market for as much money as humanly possible until only the 30th of July, where the shares will go up. Yeah, that would be great, but they won't go too high. They won't go to 300 a share, 400 a share. We're guessing that the shares are going to rise, but that they may not rise too much above the 220 level or $230 level in the next 2.5, 3 weeks. We know anything is possible with any stock. You know that, I know that, but just for this sake of this argument only, we're just going to say, all right, let's suppose that GameStop will not reach $225 a share. Let's just say it's going to stay at $225 or less right now being at 191.50, 225 a share. Let me write that number here. All right, 225. Okay, there are $225 call contracts you can write against the stock where you're saying to the market, you can buy them off of me for $225 a share until July the 30th. But here's the deal, kids. The price for this contract, you're going to have to pay me as of Friday night. Here was the market. It was there was a bid. Somebody was willing to buy, and someone was willing to sell that contract on Friday night at the bell. $8.95 a contract was the buy price, and the seller was willing to take $9.80. All right. This is the price per share. The price per contract is 100 shares a contract, as we said right up here. So you multiply this by 100. And what we have an $895 value here, and we have a $980 value here per contract. So if you, on Friday night at the close of business, right at the end of the day, you were going to sell a call contract against your 100 shares of GameStop into the option market, and you were willing to say to the buyer of this contract, you can have my stock, you can buy it from me for $225 a share, even though it's only trading at $191.50. You can buy it from me for $225, but I'll give you until the 30th of July to do it. I'll give you time. But for that amount of time, knowing what we know about how these shares can go up and down in price every day, you give me $895 to $980, somewhere in that range. You give me that much money right now, you can have a shot. You have the option to call my stock from me at $225 a share. Now, people go, what happens, Bruce, if the stock goes up to $230 between now and July the 30th? Let's say right on this day, right on the 30th, it reaches $230 a share. What's going to happen? You're going to be bought out. You're going to have 100 shares of your stock purchased from you through your brokerage account. They'll do this automatically. And they will deposit into your account $225 per share for 100 shares, cash credit in your account. However, you already have a cash credit in your account because you sold this contract between $8.95 and $980 a share. Let's say you sold it for $950, somewhere in the middle. If you sold this contract for $950, you have that money in your account now. That's $950 a share. And you're getting the $225 on top of that. You're actually going to be paid in total $234.50. That is the $225 plus the $950, having sold this contract or written this contract. You wrote it. So by writing the contract at $950 and getting taken out at $225, if that were to happen, you're being sold out, you're being given $234.50. But I told you that the stock was trading at $230. It's not trading at $234.50, it's just trading at $230. For you, as a holder of 100 shares, you are actually saying to the marketplace, you can have my stock at $225 plus $950. It's $234.50 is my price. That's actually what I'm selling this for or offering it for. The person who exercises this contract probably didn't buy the contract from you at $950. Someone who is actually exercising this may have purchased the contract at $3 on the open market because they will fluctuate with the price of the stock. At the moment that Friday night rolled around, when we were at $191.50 a share on the stock, the contracts had a value of between $895 and $980 a piece. That was the value of the contract at that moment in time. If the shares on Monday morning, however, start trading at $195 in the first 15, 20 minutes of trading on the open market, these go up $4 or $5, these will go up a couple of bucks as well. These contracts will be trading more in the $950, $975 range to the $1050 range. They will start moving up as well. They won't go up dollar for dollar, though. If this goes up $1, these won't go up $1 because these are out of the money. These are 225 contracts where the stock's at $191, now going to $195. At $195, this stock is closer to the 225 call price, the exercise price. At say 200 a share, it's closer to the 225, but it's still $25 behind the actual exercise value. So no one's going to buy your stock from you Monday morning at 225 if you have written this contract Friday night. No one's going to buy the stock off you for 225 if they can buy it on the open market for 191, 195, or 200 or 205. The only way they're going to buy this stock from you at 225 is if the share price goes up dramatically in the next 18 days between July 12th and July 30th of this year. Why would you want to do this as a shareholder? Why would you want to risk your stock like that? Why would you want to put it up? The thinking is simply from your end, you're going, okay, I'm a long-term believer in GameStop. I think GameStop can go to 300 share, 500 share, 800 share, but it won't happen overnight. It might, but I don't think it will. I'm more than happy to say, you know what? If you give me $950 now for the next 18 days, I'm a happy camper because that's almost $1,000 in my account. The minute I sell this contract, the money's in my account. The credit, it's right there. I can do whatever I want with the money. I can pay a credit card bill. I can buy more GameStop with it. Not that you're going to buy a lot, but with $950, you can buy 4 more shares and just keep accumulating stock. You can literally write call contracts against your stock to buy more stock in the company. If you've got 1,000 shares now and you write 10 of these contracts, you're bringing in $9,500. Well, you're able to buy $9,500 worth of stock at whatever it's trading at the minute you get that dough. And if you're using this strategy to accumulate more stock, as soon as you get to 1,100 shares, from 1,000 shares to 1,100 shares, you can write another call contract. Now you can write 11 at a time instead of 10 at a time. So there are investors out there who are long-term fans of the company. They believe in the upside of the company, but they want to be paid to hold it while they're waiting for their payoff. They believe that writing a call approximately $34 away from the money, running at 225 when it's only at 191.50 is a smart way to go. And they want to use the money to buy more stock. Now, there's a couple of things that can happen in between these 18 days between July 12th and July 30th on this one example contract. And this is where additional strategies come in that can come in really handy and can make you an awful lot more money. First of all, the shares, if you sold this contract Friday night and you've sold the contract for $950, you're locked in. If on Monday morning the stock opens in the first hour of trading and it goes down to $180, it goes down $11. We've seen this happen before. If it goes down $11, these contracts will go down in price too, because of course this contract, the value of this contract will fluctuate with the price of the stock. If the stock goes up, these will go up. Stock goes down, these will come down. The stock drops down to 180. That's an 1150 drop approximately. These contracts might lose $2 or $3 of their value. They might only be trading at 750 at that point in time. If the shares go even lower, say that afternoon they reach 170, we have a real drop off, more than 10% in one day. You know that's possible on GameStop. We have these short trading restriction rules that come in when the stock drops more than 10% in a day. A $19 drop, a $20 drop will take this to 171. That will take these contracts down to like $5, $5.50. It's possible that on Friday afternoon, someone sold and wrote one of these contracts, or 10 or 15 or whatever number they did, 2 of them, 6 of them, didn't matter. And it's possible that by Monday afternoon, they could buy them back at $5.50 a piece because the stock dropped $20 a share. If the stock's $170 on Monday afternoon and these are down to $5.50 a piece, you can buy them back. And the individual buys this contract back and they have now nullified their position. They don't have an option against their stock anymore. They sold it at $9.50, bought it at $5.50, made a $400 profit on one contract. They're closing their position. When you sell this contract at the very beginning, the first move you make will be to sell to open. People ask me all the time, what do these terms mean? Sell to open. So if you sell it for 9 in between this price, you're selling to open. That's your first move right there. But when you buy them back at say $5.50 a piece, or at $6 a piece, or $2 each, whatever price they're at, you are buying to close. It's buy to close. And this is the two transactions that you're making. You're doing the opposite of what the buyer of the contract is doing. The buyer of the contract is buying to open, selling to close. You're selling to open, buying to close. You're the reverse. You're the George Costanza. You're doing the opposite. Because your thinking is, well, if the shares take a dump during the day, these contracts will take a dump too. They won't go to zero, but they'll go down several dollars a contract. Every dollar these things drop off is $100 less to you to buy them back. Since you sold them at $9.50, they go to $8.50, you're up $100. They go to $7.50, you're up $200. That's on one contract. Obviously, if you're doing 5 contracts or 10, it's multiplied, right? So you might just buy them back right away at $5.50 and go, hey, you know what? I made $4 a share profit on this contract deal. That's the good news. The bad news, my stock is down $20 a share. Gosh darn it. It went from $191 to $171. I lost $20 a share, but I'm not selling my stock. I'm a long-term holder of the stock. So I don't like it, but I'm not selling. But I did get $4 for this contract by just by having it go down and buying it back. Well, what happens if on Tuesday we open up for trading and the stock closed at 175 on Monday night? Tuesday morning, the stock is back to 191.50. It goes up in the first hour and a half of the day. It goes back to here. Guess what? Those contracts, you remember those contracts that you sold and bought back? Guess where they are now? They're back here again. They're back to this 895 to 980 ballpark because the stock came back to 191.50. Maybe you will sell to open a call contract against your stock again. You did it on Friday, bought it back on Monday. On Tuesday, you're selling another call contract against the stock a second time. And 3 days later, the stock drops down to 170 a share again. It has another one of those lousy days. Guess what happens to the options? You got it. They go down in price again to this 550 neighborhood. And guess what you might do? You might just buy them back again. Buy to close a second time. You made $4 a contract the first time it did it. You're making $4 a contract the second time it did it. You've earned $8 a share in profit on contract writing. And you've done nothing with your stock. You're just holding it because, again, you're a long-term believer. If you make $8 a share on 100 shares, that's $800 against the cost of what you paid for it, or your carrying cost, or that is $8 of compensation against losing $20 a share in value from 190 to 170 because we've had a bad, 3 or 4 day run. So you're actually down $12 a share instead of $20 a share. Whereas someone who did nothing, they just held their stock and they're just letting it ride and they're letting it fluctuate and up and down. They're down $20 this week. You're down $12. 2 days later, stock goes back up again. Goes back, just using the same example. If it actually does it again, goes back to here again or higher, you might well write the contract a third time. You can write contracts unlimited times against your stock and buy them back unlimited times if you wish to. But you don't have to. You don't have to do anything once you sell this contract. You sell this contract at $9.50, as I said originally, when the stock was at $191.50. And this contract has 18 days to live from the 12th of July until the 30th of July. It has 18 days. Every day that goes by on the open market, and I've said this a little bit earlier, it trades Monday to Friday, and we're talking about Monday, July the 12th is the first day.
It doesn't do after hours.
Options don't trade in the after hours. Options only trade during market hours. That's when Chicago's open with New York. It's the only time options trade. Every day that goes by, this contract loses more life because the 30th of July is coming. Now, let's just say you sold this contract Monday morning for $9.50 a pop. He sold one contract for $950. All week long, the stock sat between 180 and 200 a share. It just sat there, and Friday night it was 191.50. So at the end of the week, the stock didn't move at all. It's just the same price. Monday morning, a week later, that's the 19th of July, a week after this date right here, this contract will not be trading at $9.50 a share. All week long, it will start shrinking in price, because as each day goes by, the option market knows that this contract is way out of the money. It's a 225 exercise contract. The stock's at 191.50. It is still $34 out of the money, but there's only 2 weeks left to go. There isn't 3 weeks left to go. There's now 2 weeks left to go. There's literally only 10 trading sessions left instead of 15 trading sessions. This contract will be about $7.50, maybe $7 the next Monday. If another week goes by and nothing happens, you don't do anything. You don't buy these back. You don't write more. You just sit tight. And the stock, again, just fluctuates between 185 and 195. And at the end of the next Friday, it's at 191.50 right up here. Monday morning, with on the 26th of July, the 26th, with 4 days to go. That contract has 4 days left to live. Well, it has 5 days. It has Monday, Tuesday, Wednesday, Thursday, Friday. But Friday night, it's over. These are going to be trading at about $4, maybe $3 each. Because again, we're down to 4 or 5 days left to go. We're way out of the money here with a 225 contract. These contracts are going to die worthless on Friday night. If the stock does not get to 225, these contracts will be worthless. And so on Monday, they're worth $3.50. On Tuesday, they're worth $3. On Wednesday, they're worth $2.50. On Thursday, they're worth about $1.25. Friday morning, they're sitting at like 75 cents to $1. Friday afternoon around noontime, with 3 hours to go in the market, 4 hours to go, they're going to be at 45 cents a piece with an hour to go in the day. If the stock is at 191 and this is a 225 contract, these are trading at a nickel. There is no value. They will die Friday night, July the 30th, 2021, with zero value, meaning that you get to keep all $9.50 that you received if you sold them in between this price here, as I was saying, around $9.50. So it's a $950 profit to you for your 100 shares for 15 trading days. Can you handle that? Would that be all right? Because guess what you're going to do on Monday? Next Monday, you're opening up your eyes and watching Bruce on Stock Markets with Bruce, and you're going, I got 100 shares of GameStop. I don't have any contracts against my stock because they died on Friday night on the 30th of July. You know what I think I'm going to do? I'm going to take a look at maybe 3-week contracts from now, this being the first week of August. I'm going to look at maybe August 20-something contracts at 225. And I'm going to write a contract that has about 18 days of life left in it. And I'm going to sell it for around this price right here. Maybe I can sell another contract for $950 again for another 18-day run. And I'm not doing anything. Every 18 days, I am offering up one call contract on my 100 shares of GameStop, and I'm going to take in $950. If the stock doesn't want to go up to 225 or more, I get to keep the money. Here's the home run of home runs. You sell a call contract against your 100 shares of GameStop when the stock was sitting at 191.50. You sold that one contract. You took in $950, okay? Every Friday, your shares are $7 higher than on the previous Monday. So at the end of the week, you're at 198.50. The next week, you're at 205.50. And on Friday, the day your options die, your stock's at $222 a share. Guess what this contract is worth right here on Friday? If the stock's at 222 and you have a 225 contract, your contract is worthless. It's $3 out of the money. It used to be $34 out of the money. It's still $3 out of the money. It expires with zero value. Now, you make $950 profit on the contract because you sold it for $950. You didn't buy it back. It died worthless. But the good news, on top of that, your stock went from $191.50 to $222 in the same time frame. Your actual account has gone up in value from $191.50 a share to $222 a share. So you're going, I'm making money on the stock, and I got $950 in cash to sell this contract. And on Monday, I can write a new contract against this stock. Now, what price should I sell my next contract for if the stock is sitting at 222 on Monday morning? You're not going to write a 225 contract. No, you're going to add $34 to the contract, to the price of the stock, like you did the last time. You wrote a contract that was $34 out of the money. You're going to write another approximately $35 out of the money contract. So you're going to write maybe a $250 contract, or a $260 actually. You'll write a $260 contract good for 18 days, which will bring you about $9.50 a share in cash again. And you'll do it all over again. And the best scenario for the second contract, because you wrote a $260 call option, the stock goes to 255 in those 3 weeks, still underneath your option exercise price of 260. You keep another $950. So you've done that twice now. You've pulled in $1,900 in cash. Your stock has gone from 191 to 255 in 6 weeks, 5 weeks, and you're happy, happy, happy. That is the ultimate home run for option writers. And then you write a third contract. Jennifer has questions.
Time.
Yes, ma'am.
Some questions and some just comments that are coming through. So early on, Skylar asked, does the volatility change your strategy?
Yep. Yeah, volatility changes your strategy. If GameStop didn't move as much as it did, you might decide that when it's 191.50 here tomorrow, July the 12th, you might decide, I'm not going to write a 225 contract. I'm going to write a contract that's closer to the money, which means I have a higher premium coming to me. Instead of getting $9.50 a share, I can get more money if I write a lower priced contract, because the stock is getting quiet lately. I've noticed GameStop in the last couple of weeks getting a little more not as active as it was. The volume is down dramatically, we know. The price movements aren't as much. To give you an example, if you wanted to write a $220 contract, you would bring in about $10.50 a share. That's $1 more, $100 more. If you were to write a $215 contract, you would be bringing in about $11.25 to $11.50, another dollar more. If you wanted to write a 205 contract, which is still, $14, $15 away, $14 away from the money, a 205 contract will bring you about $13.50 approximately. But you got to ask yourself, wait a minute, I could get $9.50 if I write this 225, and I can get $13.50 if I write a 205. Here's the deal, though. If the stock goes up, say it goes up to 225, I'll be taken out. That 205, they'll buy that from me. But if I write a 225, they won't necessarily take me out because I'm only at the money. And I only get $4 extra in premium, and I lost $20 on the strike price because I offered my shares for $205 a share instead of offering my shares up at $225 a share. That's a $20 bill that I'm not getting, and I'm only getting $4 more for it. However, as a gambler, and as we're all gamblers, we're into the market. You're sitting there going, yeah, but I'll take the 400 more right now, and I'll keep a real close eye on this market, because if this stock starts to go up into this 200 range, I'll buy the contract back, and then I'll rewrite a new contract at 215 to replace it. I'll play that game because I don't want to be taken out. I want my stock to go up, yes, but I want my contract to die, yes. If a week from now, the contract I sold for $14.50 is now trading at $11, but the stock has gone up, the contract might go back up to $14 again. The good news, though, is your stock went up $10 a share and your option didn't change in price because it's got a week less to live. You buy that contract back for what you sold it for, so you broke even on the contract, but you're up $10 a share. That's $1,000 gain on 100 shares. And now you're going to write a new contract for $10 higher for either the same expiry date, July 30, or the week after, August the 6th or 7th, whichever that day is. You'll write a new contract that's longer in life, again, a 3-week contract, that might bring you $14, but at $10 higher exercise price. You might play that game. Go ahead.
Talk about how you can't write 2 calls on the same 100 stocks. And in some brokerages, you can't use that stock for margin anymore because it's used. It's being used.
Yeah. Well, okay. Margin wise, you're still able to use it for margin.
Okay.
As a matter of fact, there are people out there who have enough money to buy 50 shares of GameStop. They don't have enough money to buy 100 shares, or they have enough to buy 55 shares, something like that. They borrow the other cash they need, up to half. In other words, they can double their position. So if you have enough money to buy 55 shares of GameStop, your broker will let you move that up to 100 shares, lend you the money for the remaining stock to purchase. Now you have 100 shares. You write a call option against those 100 shares immediately and bring in $950, like I'm showing over here. So that 950 goes against your margin balance, and you owe the firm less money than you did originally. Yeah.
Another question that's been tossed about, though, is that if you are going to, like you're talking about how I've sold them, and then like 3 days before they expire, I might buy them back. Or if I see the stock is going up, I'll buy them back.
Yeah.
So you have to have those funds.
Yes.
So
or marginability.
Or marginability.
Yes.
Right.
Yes.
So,
yes.
So you have to keep this. You
in
have
mind.
to figure out what you want the money for.
Exactly right. Exactly right. Depending on the firm you're dealing with to do these option trades, some brokerage firms insist that you have an options account and a cash account at the very least. Others will say you have to have a margin account and an options account. Now, what I recommend you consider doing is opening a margin account to give you a little extra flexibility, because that's what this is all about. Being an option writer, you have to be a flexible person. You have to be flexible in one way, where the stock will just stay where it is and the contract will die worthless. That's one flexibility. Another one is stock goes down, you buy the calls back. Stock goes up, you write the call again. The stock goes down, you buy the calls back. That's flexibility. Sometimes you need capital back and forth. Sometimes shares go up in price. You buy calls back at a loss. You sold this call for $9.50. It goes to $12.50 because your stock is taking off today. You buy these calls back for more money than you paid them for them, or what you got for them in the first place. You don't mind buying them back for a higher price. You really don't mind buying them back for a higher price. The reason is, the only way you would buy these contracts back at more than what you sold them for is because your stock went way up. Remember, the stock was $191.50 when you started this whole thing, and it's a $225 contract to give you $950. To make you buy this contract for $300 more, this stock would have to go to $220 in like 2 days. Like by Wednesday next week, this has to be $220 a share to be within $5 of this price. That would move this option up. You don't mind paying $12.50 to buy this callback. You don't mind at all. You just have to make sure you have the money, because you only have $950 in your account. That's all you got when you sold it. You need $300 more to buy it back. But here's the reward. You buy it back for $300 more. Your stock went up from $191 to $220 already. And now you're going to write another contract against your stock. Maybe it's for July the 30th, the expiry, but it won't be a $225 because the stock's at $220 a share. You might be offering a $275 contract, which can bring you in between $950 and $1,250 a contract. So if you find a contract going forward that can bring you $1,250, how much you just spent to buy this thing back, you're going to rewrite a new one for $1,250. It could be that you write a contract for August the 6th at $270 or August the 13th at $270. You're adding more time to the contract, writing a longer term contract that gives you more money. The more time the contract has left on it, the more valuable it is. Whether it's in the money or out of the money doesn't matter. Contracts are worth money, more money, the more time they have to live. So you might write an August the 6th contract that might be a $270 and bring in $14. Even though you just paid $1,250 to buy this one back, you just added $150 to your account. And you will not be exercised at $225. You can't be exercised anymore $225. You bought this one back. You're now writing $270 contracts, which is $45 a share higher than this one was. Yeah.
So what happens if you're coming up on a big anniversary and you're spending 3 days planning a wonderful getaway for you and your wife, and you're not paying attention to the market? and you get exercised. Tell them what happens when you get exercised.
Okay. Well, you're at the airport in Cancun, Mexico, and
Oh my gosh, I just remembered.
you pick up your phone and you take a look at how you doing with your account. How's my stock doing today? And you take a look at your market and you go, oh my God, my GameStop shares went to the moon. What am I going to do with my GameStop shares? You look at your account and you go, oh wow, there's a $22,500 increase in cash in my account. On top of the $950 I got when I sold this contract, I have $23,450 cash in my account. And then you look at the rest of your account and you go, my GameStop shares aren't there anymore. And oh, that contract that I wrote isn't there anymore. My contract is gone. Contract is gone. The stock is gone. And there's all this cash sitting there. You're going to sit there and go, well, I'm not sure how I feel about this. About a week ago, I wrote this call contract when the stock was at $191.50, and I brought in $950, and now it's 2 weeks later, and I have $23,450 in my cash account. Well, then you realize, yeah, but you know what? My account was only worth $19,100 a week and a half ago. Now it's worth $23,400. I'm richer, nicely richer. Fret not, my friend. Going from 19 grand to 23 grand is a good move for a week and a half. All you're going to do on your phone in Cancun, if the market is still open, or the next morning when you're in your suite in your villa in Cancun, you're going to wait for the opening of the market. And you're going to go, oh, the stock is trading at $226 a share, $228 a share. No wonder I got bought out. Of course, the stock went up. I got bought out. You're going to buy your stock back. You got the money sitting in your account.
Or wait for a dip.
Maybe
or
the stock.
something else.
Maybe the stock had a real run and went up to $233 a share, and that morning you open the market and you're listening to me on your phone, and I'm saying to you, oh, we've had a great run on GameStop yesterday, but you know, it looks like it's topping out a little bit here. There's quite a bit of stock coming in for sale, and you go, you know what? I do want to buy these back. I really do. I love GameStop. I always will, but I'm only going to buy the shares back if they dip. And what if they do dip back to 222? Go from 234 to 222. You know that can happen in half an hour. And at 220, so you put a buy order in for 222.10 for 100 shares, like I've taught you, 10 cents above the nice round number of $222, and you get hit, and you're long 100 shares of GameStop again. And you're sitting there going, this is great. I want to write a call option against this stuff. Sitting at 222 right now. What call can I write? What option can I write for the next week or two or three where I can bring in about $1,000 in fresh cash? Well, it's likely you're going to be writing a $250 to $260 call option for maybe 18 days of length. And here we go again at a whole new level. So 222 is your entry price. You're writing a 260 call option for $950. And you're saying to the market, come on and take me out. I dare you, GameStop. Come on up to $270 a share. Buy me out at 260. I got 260 plus 950 already. I'm selling at 269.50. I just bought at 222. Take me out. I dare you to do it in 18 days. But what if the stock only gets to 258 and 18 days comes and goes? Well, good news, kids. You bought at 222. It's now at 258. You made money on your stock. And more importantly, that 950 contract you wrote died worthless, because if the stock is at 258, you have a 260 contract against it, that contract dies worthless. You keep the 950 as well. And now you're writing a new contract. Well, from 258 looking forward, you're writing a $290 contract, maybe a $300 contract. Good for 12 to 18, 25 days, something like that. You're going to do it again, bringing in another $950 again. Cash in, cash in, cash in. You never stop writing contracts, and you're using your stock as a tool, like a hammer that a carpenter has, to make you money. You love the company. You love Cohen. You love everything about GameStop. It's great. but you also like making money, and you have a substantial amount of money into GameStop. 100 shares is worth $19,000. Make this money make you money. And this stock is offering it to you on these options. Jen, another question.
Question is, when they're looking on their screen, the many that you can, underneath the bid, it says times 30. And under the offer, it says, the ask says times 55 or 105.
Right.
It was answered by one of your other viewers, because these people are awesome.
Yes, they are.
But I think it's something that everybody could benefit from. What those numbers mean, and what does it mean when the bid is 30 and the ask is 150?
Okay.
Or when the bid is 150. Yeah.
Different numbers. All right.
Both ways.
All right. Well, this is true on stocks and on options. This is not just an option question only. So let's just assume that there's we're looking at a bid ask. So we have a bid here. We have an ask here. Okay, and we have last trade. All right. Now, well, let's say it's an option contract. Okay, it's an option contract that we're following. So it's the July 30, $225 call option, and the bid on it is showing, say, $850 price, and the ask is $930. Okay. Last trade at, say, $9. I'm just making all this up. All right, there we go. As Jennifer was saying, you see these little numbers sometimes that make us wonder, and they're either behind or below it. But you might see something like a 50 here, and you might see a 30 here. Okay, hope you can read that. Okay. What this means is there's a buyer at 850 looking for 50 units. There's 50 contracts wanted. There's 30 contracts available at 930. So what we see is a 50-30 ratio. We see 5 for every 3 available, there's 5 wanted, or for every 5 wanted, there's only 3 available. The market might change in 15 seconds because the stock is going up or going down, and all of a sudden we're looking at a bid ask that might be like 825 with 30. And an 875. Here we go, 875 with 60. And so what we have now, sorry, I should have used this in red. So what we have now is 30 and 60 on the numbers. 30 units wanted, 60 for sale. Whereas before it was 50 wanted, 30 for sale. These numbers change with every trade. Because if the last trade in here was in this 850 range, forget all the colors. We have all of these changing quotes second by second, minute to minute, depending on how active these things are. This can be stock quotes. This can be a quote on a SPAC stock. A SPAC can be 850 to 930, or it be 825 to 875. Or we can see quotes on SPACs like let's see SoFi. Okay, SoFi shares. Say they're 1650 and 1660. And then we have here maybe 100, and here we have 150. What this means on stock is that there are 100 board lots of stock wanted. A board lot is 100 shares. So that means 10,000 shares are wanted and 15,000 shares are for sale. Board lots times 100. That's all this means. So we have 10,000 versus 15,000 bid ask strength. Sometimes it shows a 1 and a 4. 100 wanted, 400 offered. It can show a 6 and a 9, or a 6 and a 2, or any 2 numbers. It's board lots. Those are your bids, asks, and then you have your last trade.
So that's why you'll hear the expression, there's more sellers than buyers right now. Or there's more buyers than sellers.
Yes.
Even though every sale has a buyer and a seller.
That's correct. What we don't know is how many buyers there are that make up this 1650 and how many sellers are making up the 1660 sell side. We know how many shares are available and wanted. We just don't know how many people this represents. This could be just one big buyer. This could be one big seller, but this could be 15 and 8. It could be 20 to buyers and one seller. We don't know that. Now, on some of your level 2 trading systems, you do show all the bids and all the asks. And you might find that on the bid side, there are buyers at 1650, 1649, 1648, 1640, like every penny there's buyers. But on the sell side, you might find that there's a seller at 1660, but the next seller is at 1663, the next seller is at 1670, and then there's a seller at $17. That's thin on the sell side, heavy on the buy side, or the reverse. It can change at all times. Options do exactly the same thing. The thing though with an option is this represents $850 for one contract. This is $930 for one contract. This represents $16.50 for one share, and this represents $660 for one share, unless you see how many are wanted and how many are offered. But these numbers can change at any time as stocks trade actively.
Would there ever be a reason to write a call contract that is already in the money?
Yes, there is. Yes, there is. Why would you want to do a call option that's already in the money? And the answer is simply this. Let's talk about, you remember about a month or so ago, we were following GameStop, and the shares were trading about, if I recall, let me just write this in here. GameStop, the shares were trading at about 160 a share to about 185 a share. And that was not too long ago. That was about a month and a half ago or so. And then they took a shot. You remember the shot they took? They went from this range to about $230 a share up to the $330 share mark. You might recall we had this move in the GameStop shares. It was a good 2 weeks, wasn't it? It was a great 2 weeks. And I was yelling at the camera, 346. You got to give me 346, because that used to be the high we had way back in March when we got attacked in one day. 25 minutes from hell, the stock went from 346 to 171 back to 285 with 5 trading halts. Remember that? Who forgets? Anyway, here's the thingy. Why would you write a contract that's in the money? All right. Here's the mentality. All right. The stock took a shot. Now we can see how these shares can make these moves. You know, we're very used to it. All right. But let's say you're a shareholder of GameStop, and you're thinking, this 330 price, we got here way too fast. I mean, it just
saying they remember this day.
They remember this day. We got up to 330. That went like a little too fast for my comfort. But I'm a shareholder. I've got 100 shares. I have an average of $160 a share. I've had it forever. Been watching with Bruce. Every time it dips, I buy more. I got my stock. So let's say I have 100 shares, and my average is 160 a share. All right. And I'm a happy guy with this price of 330. This is great. But I want to write a call option for like a month. I want to write a call option for a month, and I want to bring in some serious money. I want to bring in real big premium money. But I don't want to be exposed for more than a month, maybe even less than a month. Here's one strategy you could go with. For example, if you were to write a call option, and let's just, this is July now. All right, we're into July. So let me do a July 30 again. July 30 only. I'll play this game. So it's July 30 expiry. Okay, the contract expires July the 30th. All right. If I write, let me take a look right here. I'll use real life examples right now.
Those are the best.
Yeah. Okay. As of Friday, a contract that is at the money in GameStop's case. The stock was 191 on Friday night, 191.50 approximately. The 192 contract right now has about a 1750 value to it. Okay, so at 330 though, so I'm going to go a $330 strike price. That contract would probably trade at about $18 a share, expiring July 30. If I were to consider writing a contract out of the money instead of in the money, first of all, I'm going to be taking a look at maybe a contract that might be $20 out of the money. A 350, I would get about $10 for that. So a 350, terrible penmanship. I get about $10 a contract. So if I write a contract for 330, I'll get $18. If I write a 350, I get $10. Okay. I sure hate the look of that 350. Okay, but if I write a contract at 300, this is in the money. All right. This contract is $30 in the money because we're trading at 330 right now on the open market. This is worth at least $30 in book value. Plus, it's worth time until the end of July. Not a lot of time, but it's got time value. We know that the 330 that's at the money has an $18 time value only to it because it's a 330, which is where the market is. But this one will probably trade at about 40 odd dollars a contract. It'll have $10 of time value on it. Here's the strategy of this seller. The seller is saying, you give me $4,000 right now. I'll take $4,000. This is 100 shares. I'm going to get $4,000 for my 100 shares. And you can have my stock at $300 a share between now and the end of July. Okay. Why would he do that? Or she? Why would you do this? Simple. You saw the stock go from 160 to 185 up to the 330 mark in like a week. And you're sitting there going, yeah, this is great and all. People talk about going to 1,000 right now. I don't think so. I think there's going to be some profit taking first, and maybe then a little later it'll do more. I don't know how low it'll go, but it's going to go a bit lower for a bit of profit taking. Maybe it can come back into the 250 neighborhood, kind of consolidate there for a while, and then maybe it'll go higher. Maybe it won't. But as an option writer, I'm going to say, you know what? You give me $4,000 right now for my for my $16,000 purchase. I bought these 100 shares for $16,000 when I bought my 100. Give me $4,000 right now against that cost. I'm into this stock now for $12,000. I know I'm on the hook. You might be able to take me out at 300 if I get exercised. I get exercised for 300. In effect, though, I'm selling for $340 because I'm taking the $300 exercise price plus the $40 contract I just sold. I'm actually getting $340. So you just put a big little plus sign right in between these two guys right here, and I'm getting $340 if I am exercised. That's $34,000 for a stock that cost me $16,000. That's step number one. That's the first thing in that person's mind. The second thing in that person's mind, the shares go down to $285 a share. They go down to 285. By the time the contract expires, the stock's at 285. Guess what? This contract is worthless because at only 285 a share, the option is out of the money. If the stock's at 285, this thing's out of the money by $15. This contract will go from $4,000 to zero in value. That's the bottom line. So this option writer just took in $4,000, gets to keep all $4,000, still has his 100 shares. The bad news is that stock used to be at $330. It's now at $285. But the good news is that the person who wrote this contract has their $285 stock plus $4,000 cash in the bank. They can do whatever they want with that money. He could now write a $260 contract against it if he wants to, in the money, thinking that the stock might go back down to 250 or 240. He writes a 265. He might pull in $25, $30 a contract. He takes another $3,000 off the table. He now has $7,000 in cash in his account. And if the stock does go to 245 a share, he's got 100 shares at 245 and $7,000 in cash. That's why you would take that kind of a strategy. If you are up on your investment and your stock takes a real nice shot, but it just has a sort of falters for a day or two, you might strike while the iron is hot and write an in-the-money contract for 2 or 3 weeks only, where you're just going, this thing backs off just 10%. It'll go from 330 back to 295. This contract is worthless, baby. This 300 has got zero value to it. I just scored the $4,000 gain on 100 shares. Think about that. That's a lot of money. Yes, ma'am.
I'm not sure what this comment is from Wendy, but it says, she says, what did Uncle Bruce say Do not write options until the stock hits $30.
SPACs.
Oh, okay.
SPACs. Okay.
I was thinking maybe it was like the 330 and you forgot the 3
Right.
part.
Right. Yeah, we're going to get into, I'll get into SPACs in just a moment.
Okay.
I just want to finish off this GameStop story here. GameStop shares are volatile. We all know that. You guys are some of the most aggressive gamblers in the market if you're a shareholder of GameStop. You follow me to have me talk you off the ledge from time to time, but you guys you're gamblers. You're not sitting on IBM stock as your primary holding. You're not sitting on bonds. You're not sitting on mutual funds. You're sitting on GameStop. There's a reason why we're into the GameStop. We've gone over it a million times before. But while we're into this thing, this stock should pay you. If you can write a call option for $950, and I'll just write that up here. You write a call option for $950, and you can buy it back for $450 within a week of writing it and score a $500 gain. Okay? If you can actually read this writing and understand what I just wrote, you are geniuses. You're making a $500 profit on this contract on 100 shares. That pays for a whole bunch of my classes. That pays for my channel big time. This is chump change when it comes to GameStop. And many of you know that. You know how your GameStop contracts have unbelievable values. I'm just quoting you right here that on Friday night, when we closed at 191.50 or so, the 192.50s, that the contract that's the next one available, the 192.50 call options, we're trading at about 17.50 a pop. And they only have until July 30th to live. They've got 15 trading days. That's it. That means that for every day that goes by, those contracts are losing $1.20 a day in value if the stock does not go above 192. Now, this is right at the money. This is all-time premium with a 192 call option with an 18-day expiry. A $200 contract on GameStop, you want to buy one of those or sell one of those, you're going to receive, as a seller, about $15.50 a share. $15.50 a share to make a gain of $8.50 on the stock. I mean, you could literally buy 100 shares Friday afternoon at $191.50, write a contract for $200 right away for the 30th of July, and be paid $15.50 right now, cash. You take the $15.50 off the $191.50 you just paid for the stock, and you just brought your cost down to, what would that be, 181, 175 or something like that? Your cost is now 175. The stock doesn't go over $200 a share by the 30th of July. You keep all that money. If the shares stay between 191 and 200 between now and the end of July, those contracts will die worthless. And that money is all yours. You're now a shareholder, plus you have $1,550 in cash. You can write new options all over again, and away you go. Or the shares take a dip, like I said earlier, they take a dip next week. You buy these 1550s back for $8.50 or $7.50, and then you rewrite them again at $14, $15, and you buy them back at $6, $7. You write them again at 12. You buy them at 4. You write them at 10. You buy them at 3. You write them at 9 and buy them at 5. You can bring in $3, $4, $6, $5, $8 every time you rewrite them. Sell them, buy them back. 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 Again and again and again. You do that 5 times in the 18 days of time. 15 trading days. Every 3 days you're flipping them. You may find that you didn't generate $15 a share in profit on your GameStop share. You generated $30 a share in GameStop profits. You still have your 100 shares, but you made $30 profits by selling and buying back call options that you've written again and again and again against this 100 share position. That's $3,000 in your pocket by being an active trader against your own stock while you're holding it. And you could take that $3,000 and buy more stock if you want, or pay off a credit card bill, or do whatever you like. Buy something else. Absolutely. Yeah.
They're asking if you could do an example with something that does not have the volatility that a GameStop has. So maybe an IBM, or Apple, or something that still has, the examples they said were IBM, Apple, or Disney. Now these all have a lot of volume.
Yeah.
But
Yep.
they don't have the volatility.
Right. That's right.
So
Okay.
explain how that's going to affect the prices that you'll be able to ask for.
All right. Well, let's take a look if we can at maybe I can take a look at maybe IBM, because we're into IBM as well. So let me do that here.
Someone's reminding people, don't forget to pay your taxes.
Well, that's true. You will have capital gains. Again, I'm trying to give you a nightmare, trying to make you filthy rich with all kinds of profits, and you're going to have to hire tax people to help you out. But don't worry, they're much cheaper to hire than the kind of money you're making. So you're going to be fine.
That's it. You're a shill for the accountants.
I'm a shill for auditors. I'm a tax auditor shill promoting the tax guy. There you
Yay,
go.
bean counters.
Finally, the truth has come out about this guy. Now we know what he's into. Oh, he's such a crook. What a guy.
This person said they'd forgotten to pay their tax for the past decade, so I start now.
Why start now? They don't deserve it. Okay.
Yeah.
All right, I'm looking up IBM right now to try to figure out what's going on here. So we're going to go IBM. How do you see that screen? There you go. Okay, whatever.
Yep.
IBM closed at 141.30 on Friday night. That was the last trade on IBM on Friday. So let me take a look at contracts. Let's say we want to write something in late July. Again, to kind of compare one to the other, okay? Alrighty, so I'm going to show off July 30th call contracts, just for the heck of it. And to kind of give you an idea how much money you can generate if you want to write a contract. All right. So let's take a look at this. The stock is at 141.30 on Friday night. If you were going to have written a call option, let's say you were going to think about writing maybe a 145 exercise price, and I'll do a 148, and I'll do a 150. These are call options. All right, the 145 call option closed at 231. 31. The 148 closed at 144, and the 150 closed at 114. Okay, there's your pricing on the three contracts. Notice how the further out of the money you go, the cheaper these contracts are. If you're a buyer and you think the stock is going to go up, you can buy the 145 calls for 231, but you're out of the money about $3.70. You're going to need 370 plus more to kind of make money on this thing. Having said that, though, if on Monday morning the stock went right to 144 right away, this will probably go to about $4. But if you're a writer, you're selling these contracts, you can bring income in of $231 in cash, because times 100, into your pocket if you write this contract. So that's $231. If you write this contract, it will bring you $144. And if you write this contract, it'll bring you $114 per call contract. Now, you're saying to the market is saying to you, and you're saying to the market, look, it's a 141.30 stock. The highest it hit was a 146, 147 about a week and a half ago, which when I noticed it took a dip because of management changes. But if you're a holder of 100 shares of IBM and you write a call option, you want to write a call option against your stock, if you can write this one here, $100.44 for $144, this is a 148 contract. That would be a new all-time high, or a new recent 52-week high for the stock. You can bring in 1% of what the stock is. What does stock cost you? It costs you $141 a share. You're bringing in $1.40 something a share in premium. It's 1% premium for 18 days. Let's assume that between now and July 30, the stock does not go above 148. It stays at 145, 146, 143. It doesn't go above. You get to keep this money, and you do this every 18 days. Well, this is money into your pocket. This is 1% return on IBM every 18 days. This isn't a bad return on your money. I mean, you can do 18-day contracts. You can do almost 20 a year. You can do this 20 times a year. Every 18 days times 20 times is 360 days a year. You can literally write 18 calls using a strike price that is about, let's say, how difference is this? $6.70 away from the market, $6.70 out of the market, because the price here is 141 and this is a 148. So you're writing a call $6.70 out of the money for 18 days, 20 times a year. Well, if you brought this in 20 times, all right, that is not quite $30 a share. That's about $29 a share in cash. Plus, you receive your dividend every quarter, and that's about 1%, 1.1% every quarter is the value of your dividend. The dividend is about $1.50, $1.60 every 3 months, assuming they don't raise it, assuming they don't lower it either. But they've never lowered their dividend in 40 years, so dividend's kind of safe. You bring in 1% every 3 months for option premiums, for dividend premiums, and you're bringing in 20 times this in option writing. You're bringing in $29 by plus about another $6+. You're bringing in $35 a share on your stock per year. You are making 4 plus 20. You're making 24% on your stock, on your IBM stock per year. Again, this is 1% return right here every 18 days. You're doing it 20 times a year, so that's 20% return. And then you're getting a 4.4% yield on the dividend. So you're bringing in 24.4% return on your IBM stock, assuming that your IBM stock does not go up in price or down in price, that it stays at 140, 130. Now, when I started this channel going live back in January, February, you were asking me some of my favorites, and I mentioned IBM at the time. I think I mentioned IBM at 106 or $110 a share. It's already gone up $30 this year in like 5 months. It's not going to happen every 6 months. I can't guarantee you that. But if these shares reach 160 by the end of this year because they're making more and more and more money, well, that would be a $19 gain on your stock. That would be almost another 15% right there. 15% plus this return right here, you're looking at a 40% return on your stock on a per annum basis. Serious money. We're talking about the kind of stock like IBM where you can relax at night, not worry about the company going out of business. You don't have to worry about it finding a product that people will like. You don't have to worry about the company being able to pay their bills and maintain a dividend. This is this is one of the top 20 companies on the planet. It's big blue. But being an option writer, even a conservative plan where you're writing options $670 out of the money, doing that is a very conservative program. And it can be very lucrative for you. It may not be as exciting as GameStop because this stock generally does not move $10 in a day. It had an interesting run 10 days ago, and it's been slowly coming way back. It went down to 137 and is now back to the 141 level. I think these shares can reach 142, 143 in the next week or so. That's my personal opinion because they went too far too fast on the downside. Nonetheless, anybody that had written contracts on IBM when the shares were at 145, 146 2 weeks ago, week and a half ago, anybody who wrote 150s, 148s, they're laughing because those contracts are worthless because the further out of the money you get, the more they've depreciated. So you can write, like I say, $18 contract or $20 July 30s. You can write July 23s. You can write every week out if you wish to. So if you want to write a 2-month contract, you only want to write maybe 6 contracts a year on IBM, not every 18 days. Well, you can write a 6-week contract. That would be maybe an August 30 contract. You can look at writing an August 30 for, say, let's take a look here. August. Let's take a look at my quotes here. August, here we go. There's an August 6th. There's an August 13. There's an August 20. August 27th. That's the end of August. Can we get a 148 contract for August the 30 or August 27th will only bring you about $1.97. Let's call it $2. It'll only bring you $2. So 144 versus $2. You're better off writing 18-day contracts at a time rather than writing contracts that are 30 days longer. Because for an extra 30 days, you only get another 56 cents. It's not worth it. You're getting a better bang for your money writing shorter term contracts and being on top of it more. The more you put in, though, the more you get. The more time you spend watching your market, the more is a return to you. And for some of you who are using your retirement savings and you're looking at maybe 200 or 300 shares of this stock, you're writing 2 or 3 contracts at a time. If you can generate a return of 25% a year on $300,000 or $400,000, that's serious money. It's worthy of a serious look. Yes, ma'am.
Yippee Kaye is saying, well, this gives me more percentage than my bank savings do.
Yeah.
To which Peter replied, finding a quarter on the street gives me more
yes.
than my bank savings do.
Yes, that's true.
Now, here's the question. They really all want to know. And I don't think it's going to be the answer they want because you just got to do it, right? You just got to get your toes wet. You just got to get in there and get your experience.
I believe all of you, but I don't trust any of you. Okay, continue on.
Hear me now and believe me later. That, where is this example? Okay. Where did it go? A GME example. She sold 2 contracts for $122 at a $500 strike and took $35.75 premium, $35.75 premium. Friday it was worth around $25. Should she buy them back or just wait?
Okay.
That's the eternal question.
Okay, so the contract is a $500 contract. The stock is a $190 something stock, right?
Yeah.
And so we know that the contracts are way out of the money. I mean, way out of the money. GameStop $191 on Friday, writing a $500 call. You sold them for $50 something and they're trading at
$35.75 premium.
Yeah, 35 premium, and they're now trading at 20 something.
Friday it was worth around 25.
25. I would wait. I wouldn't do anything. You still have. You've made $6 so far on your contracts. You're going to make $25 more on each contract if you wait it out. Going another month or so, even if the shares go to 210 or 220, a month later from now means another month gone for those contracts. They might be trading at 22 or 21 or $18 each. By the end of September, they might be worth maybe $16, $17. Even if the stock goes to 250, they'll still be at $16 to $17. The end of October, if the shares are at $250 a share, $250, those contracts will be $12 each, $13 each, because there's still hundreds of dollars out of the money. In the last 2 or 3 months, these will go down to the $5, $6 level, and that's where you may want to buy them back quickly. On the other hand, you could play a game here where you, let's say the shares on Monday, they go down to 175 for just half an hour. And these contracts drop $4 or $5 a pop. You buy them back and lock in a profit on these. You wait for the stock to pop back to 185, 190, whatever it is. You might now think about writing a new set of calls that might not be January's. You might be writing closer in calls for, say, September or October at maybe $400. Bringing it down $100 and bringing in a bigger premium. Maybe you can bring in $50, $60, $70 in premiums by writing something in that 400 or 380 range or 360 range. That might be a good move. If you can you can write a 360 contract and bring in $60. That's like selling for 420 because you're getting the 360 plus the $60 premium. You might want to look at something like that. So you buy them back at say $25. Or $22 each, and now you write brand new contracts to bring in 60, and that's 6,000 in the door. And watch for those to drop down into the 30s the mid 20, buy them back and lock in another $3,500 gain on those, and then reassess at that point. What can I write now? Can I write contract that's a month longer than ones I just bought back at 360, 380, 420, bring in another 50, 60 bucks contracts? You might play that long-term big contract premium game as well.
So here's from Bill saying, okay, so we're talking about weeks here, but with SoFi, you were talking about January, but that was yesterday.
Yes.
So
what's the big plan on SoFi? And we're going to
remind them the difference between buying and writing.
Right. Okay. All right. Let's talk SoFi now. We're talking about our SPACs. Let's talk some SPACs. SPAC talk, kids. We're talking SPACs. Okay. Let's try this. SoFi. Okay. On Friday, our SoFi's closed at $16.45. Far too low for my liking, but that's where they are. All right. $16.45 a share. All right. I have been telling you guys again and again and again, buy call options on my SPACs, the SPACs I like, for far out, way out there, and get them around the money, kind of where the stock is. Now, we know that the SoFi shares back in about 2 months ago, before when they were still IPOE and all that, they were trading anywhere from about $14.50 a share, and then they went up to about $24 a share in that time frame. And I was talking to you guys about buying call options when the shares were in this 14, 15, 16, 17 range, and you were buying call options with expiry day, with exercise prices of about $15 a contract. You were buying 1750s. You were buying 20s. Some of you were buying 2250s. Okay, and these were the ones I was telling you to really look at were January 2022 contracts. Those are January's. All right, because I wanted you to get a lot of time to avoid what we avoided or what we had run into this past week, where our shares went down when they really shouldn't have gone down. The market went down when the market shouldn't have gone down. And then the market came back up again. And we had to suffer through all this gyration and ridiculous speculation and everything else. Well, here we are at $16.48 a share, or $16.45 or so a share. Here we are. What's the big plan? What's the big picture? I've been saying that as SoFi becomes a stock, a meme stock, and it has become that, it will increase its volume. It will trade more. It used to trade 2 to 4 million shares a day back in when it was IPOE. Then it's traded kind of that 4-5 million share a day number as it was approaching the takeover from SoFi. Now it became SoFi. It started trading like 8 to 10 million a day. Then it went up to 55 million shares a day for a couple of days. And then on Friday, it traded 17.6 million on a very quiet day. Quiet day now is 17 million shares of trading for SoFi when it used to be 2 to 3 million, 4 million shares a day. What I thought would happen to SoFi is happening with SoFi. SoFi is becoming more and more known in the marketplace, and more players are playing the stock. Yes, there are sellers. Yes, there are buyers, and it is where it is. We don't like the price, but that's where it is. All right. My hunch on this stock is that it will reach into the 20s and the 30s because I believe it's a $28 value now. I believe that this company, with the number of customers that it's adding like crazy right now, will become a household name in online finance. And I think that these shares will trade 50 to 100 million shares a day as a normal day going forward. And that kind of volume compounded and again and again and again with that kind of interest level, the stock is not going to be at 16 bucks a share. So, okay, if they go to $25 to $30, every one of these contracts that you guys own will be worth a lot more money. That was the point of trying to get you into these from this old man's point of view. At a $30 price point on the open market, if the shares reach 30 bucks, this contract will have a $15 book value plus time premium. This one will be worth $12.50. This one will be worth $10, and this one will be worth $7.50. All book value plus time value on top of that. Every one of these guys. And none of you, I don't think any one of you watching me right now, if you own any of these contracts, none of you paid $7.50 for any of them. You're into these for between $1 and $2 and $3 and $4 a piece, depending on which one of these you bought. And this is the kind of premium plus some time value on top that you're going to make. If these contracts, these shares, reach $30 a share by August of this year, roughly, you could probably add about $2 per contract for every one of these in time value. And that puts this one at $17, $14.50, $12. That's what you're going to see for premiums on these contracts. That's what they're going to be trading at. And every one of you are going to be up substantially. And what are you going to do? You're going to be hearing this guy yelling, sell these contracts, take your money off the table. It's time to cash in and at the very least do two new things. The first one is you sell these for whatever you can get for them and take about a quarter of the money, if you wish, to buy new contracts in SoFi, right up here, at whatever the stock's trading at, trading at $30 a share. You're going to buy $30 contracts, 32.50s, maybe 35s, maybe 33, 4s, 35s, 36s, 37s, 38. You're going to buy a new set of contracts for a year out to next year, August 2022, or September's or December's, a quarter of the money. The rest of the cash, I'm going to urge you to actually buy the stock. Just buy this stuff at $30 a share. If it's reached 30 on 100 million shares a day, 50 million shares a day, it ain't going back to 16, kids. It's not going back. It's going higher. You now are wanting to get into this stock. And if you get into this stock, and you have some now, I know many of you do, you're going to have more. Now you're going to become an option writer on SoFi. You're going to now make your SoFi pay you, just like GameStop. Pay me to hold this stuff is what your attitude is going to be. I'm not asking you to write contracts right now with the stock at $16 a share. I'm not telling you to write calls right now. You could if you wanted to, but I'm not telling you to do it. I am suggesting that you are going to be a call writer on SoFi, on Gores, which is going to become Matterport, on 23andMe, and all the other specs, as these will eventually work their way up $25, $30 a pop. You're going to become option writers on all of your stocks, all of your SPACs. You do some mathematics right now in your account after you get off watching me today. After we do this, you take a look at your accounts and you start figuring out how many shares do you have now of these SPACs? How many shares might you have if this happens here with your stock? These kinds of profits are coming in on your contracts. How many shares can you acquire of SoFi and these other SPACs you have, and tally up? Are you going to be sitting on 5,000 shares of stock collectively on 6 or 7 different SPACs? Are you going to have 2,000 shares collectively, 8,000 shares, 15,000 shares? How many are you going to have? Because now you're going to start thinking like the next level I'm going to want you to start thinking at, and that is, if I own 5,000 shares of stock in SPACs that used to be SPACs that are now public traded companies at $25, $30 a share, I'm going to be writing 50 call contracts against my 5,000 shares. It might be 1,000 shares of 5 different companies. It might be 2,500 of this, 1,200 of that, 1,300 of that, whatever combination it is. 5,000 shares, 8,000 shares, 15,000 shares. You do the math. I'm thinking, from my point of view, that if you've got 5,000 shares of this stuff, and you can write 50 call contracts at like a month at a time, which is the plan, because once you are a writer of these contracts, of contracts on SPACs like SoFi and 23andMe, you're not going to be writing 1 year long contracts. You'll buy 1 year long contracts as an investor for the long-term growth payoff with a huge amplification of your money, being a call option owner. But as a call writer, you're going to be writing 4 or 6 or 8 week contracts that you're looking to buy back at a much lower value as they deteriorate in price. So if you need to write an 8-week contract for, say, $3.75, and it goes down to $1.75 in a month, you buy that contract back, you score a $2 gain on your stock. You do that on 50 contracts on average, you're bringing in $200 a contract 50 times per month. $10,000 a month of capital coming in cash. This is what we're going to get into as we go forward here as option writers. You're going to start looking at these options as a way to bring in income over and above the income that you bring in now, either from retirement, pension, and or your jobs. Perhaps you and your wife or partner are both working. You may find that this third source of income coming in from these option writing programs represents one of your salaries or represents the entire salary of both of you. And the first move you might make is we're both working part-time now, or one of us is quitting the job, one of us keeps our job. And as we keep building this account up and we get to 8,000 shares, 12,000 shares, we write more contracts, we bring in 10,000 a month, 12,000 a month, 15,000 a month. Both of us quit our day jobs, or both of us work part-time only. And this third income, this income source takes over our affairs.
Well, and you have to commit the time to it. So
exactly right.
You get to that point where it's worth it.
It's more worth your time to manage your portfolio than to work at your day job, because your boss isn't going to yell at you anymore. You're going to be yelling at the computer. You're going to be yelling at this thing going, come on, GameStop, let's go. I mean, you're going to look for stock. You'll be yelling at stock to go down in price, which is kind of quirky. You'll be looking at your own portfolio going, I need my SoFi to go from 39 to 35 because I wrote these calls at 40 or I wrote these calls at 37 and I want to buy them back for cheap. You don't care which way the market goes. You just want it to go the direction you need to score your premium returns as these contracts deteriorate in price as the time goes by against them. That is the bigger picture. So when you buy these calls on SoFi and 23andMe and Gore's Holdings, I'm asking you to go way out there and buy contracts that are 7-8 months out. But when it gets time to write them, when you're becoming an option writer, you're writing short-term contracts, 2 weeks, 4 weeks, 6 weeks, 8 weeks, based on what the premium price and what you can get for them. And just like with IBM, you might bring in only 1% on IBM per month or two or 18 days or so. But on something like these, you might bring in 5% or 8% per month because of the higher volatility numbers. SoFi, if it goes to 30, there'll be a lot of speculators out there going, whoa, this thing really took off. This is the next AMC. This is the next GameStop. No, it's not. It's an online banking company. But the premiums on these contracts will be gigantic, ginormous. And you're going to take advantage of it by writing the calls. You're going to be offering calls to gamblers going, yeah, sure, you can take why don't you take my SoFi at $35 a share? They're trading at 30 right now. You can have them for 35 for 3 weeks. Give me $3 a share. Or you can have them for $36 for 5 weeks. Give me $3.50 a share or $4, whatever the market is. You'll find the contract that appeals to you. It might be a 35, it might be a 40 because you like to write options that are a nice round number. You don't want to write $36 contracts. You like writing $35 contracts. More volume on that contract because everybody likes round numbers. A much tighter spread between bid and ask on those contracts. All of this appeals to you and just turns you on, turns the market on, and gives you liquidity and good premiums. Away we go. All right. Yeah. How are we doing for questions?
We've had a few questions on the actual brokerage platform that they're using. So Pustergaard says, my place won't let me sell call options on AMC or GME, even if I have 100 of them. And are covered. They say I can't short sell, risk rating 6 or under. So that's
the brokerage.
That
brokerage firm's policies. You might want to look for another broker. Yeah.
This one says, how about the scenario where you initially bought 100 shares at $250, then you get taken out at $220? Your broker indicates a wash sale.
Okay.
Is that a problem?
No. It's not a problem because at the end of the year, when you do your taxes, your tax advisor, you tally up all the gains against all the losses, and you come up with a number. And whether you've made $20, you've made $2,000 for the year, you lost $2,000 for the year, you made $18,000, you lost $16,000. All your losses and gains are offsetting each other until there's a net number. It's a net gain, a break even, or a net loss. And at that point, that's what you're declaring to the feds. It doesn't matter if it happened to be a week later. It's not your fault that you got bought out or you decided to sell a stock that you made a killing on. you're not going to have a massive tax problem when at the end of the year, all the transactions are tallied up and tallied up and tallied up. Your auditor, your accountant, whoever you're using for your tax purposes is going to say, hey, you bought 100 grand worth of stock. You sold 120 grand worth of stock. You made a profit of 20 grand this year. That is considered a capital gain under IRS rules. And so here's your tax rate on the capital gain. Away we go. Now, if you are very active in the market, hopefully you will be, you might incorporate an LLC that you're going to utilize for all of your trading eventually, because eventually we hope you're dealing in hundreds of thousands of dollars in transactions and a lot of profits. Well, that should be generated inside an LLC with all kinds of write-off allowables that LLCs have versus private individuals. And so that, again, that is private consultation that I can't help you with because I'm not a tax guy. I'm not a candidate. Yeah.
And the other thing that you did speak of shortly, very quickly, is that you have to, when you're looking at your profit on any deal, stock, options, whatever, you have to take into account the commission you had to pay for it. So you have to deduct that from your profit.
That's true. And remember, any commissions and fees your broker charges you is a write-off. Whether on a personal level or on a corporate level, it's a write-off. And this is where you will receive from your brokerage firm, I believe at the end of every calendar year, maybe even quarter, maybe every month, or anytime you want, you can download a PDF or a print-outable statement of all transactions with all charges and fees, and they can itemize that for you. And if you can't understand it, you pick up the 800 number and call them and say, hey, listen, I'm trying to figure out my tax situation. What'll happen? And they'll say, oh, yeah, tax situation. We'll send you a profit and loss statement for the year, a detailed profit and loss statement showing you all of your gains, all of your losses, all of your fees, and it'll show you your summaries. And that's what you're going to hand to your tax professional when it comes time to figuring out your taxes. Yep, that should be the way to go, right?
I think we're going to have to do puts next time because we're already
at 2 hours.
2 hours in.
This is how complicated this is. Puts are the opposite of what I just said. Okay, well, there you go.
There you go. Okay, bye.
It's so simple. What more do you want? Yes. Writing a put, of course, is gambling the opposite direction of the market. Now, people ask me, why don't you talk about writing puts as much as you talk about writing calls? And I have several answers for that. As you folks know, for example, was it on Thursday? We saw GameStop drop more than 10% in one day. Was that maybe Wednesday? I can't remember the day. Stocks drop a lot faster than they come up. You'll notice that when the Dow drops 500 points in one day, it might take 3 days for the Dow to come back. It might take a week. What was it last year when the COVID hit? We saw the markets drop 35% in like a week and a half, 2 weeks, but it took 4 months to come all the way back and go higher. That's how life is. That's how real estate is. That's how stocks are. That's just normal. Puts will react like stocks react. So if you write a put contract and say, yeah, listen, I love SoFi. You know what? SoFi at 16.45, I think this is a great stock. It's going to go higher. But I'm going to write a put contract. I'm going to write a $14 put against this stock. And I'm going to bring in $1.50 premium on it for, say, a month. And if the stock goes down, I'll buy it. Yeah, sure, no problem. Well, what happens if the stock drops to $10 in one day? Because the Dow dropped 1,800 points today because somebody said something about interest rates. Who knows? Goes down to 10, you're getting exercised. You're going to have to cough up the $1,400 a share to buy those 100 shares. Okay, you have the money, you do so. But those puts, you only got a $1 premium. They're now trading at $4. Your price to pay is to buy the stock. If you don't want to buy the stock, you actually want to write a put, but you don't want to get assigned. You don't want the stock. You think it's going higher. This can drop $2 in 15 minutes. We know how these markets work. On GameStop, it can drop $30 a share in 30 minutes. We saw it drop 100 from 346 to 171 in 25 minutes. We've seen it. A whole bunch of put contracts could have been assigned on that drop off dramatically, and you have to buy the stock at a much higher price than it's trading at, and that's even worse. Put contracts also don't have as much volume as call contracts do. There's just more players in the call side because people are wired to buy low and sell high. That's how they think. And so the spread between bid and ask on puts might be higher because it's not as liquid a market. It might not be as easy to get in or get out on a put contract based on whether it's in the money or out of the money as well. That's another factor to consider. Put call writing is what most people do. You get much higher, generally speaking, you get higher premiums when you write calls versus writing puts for the same time value and exercise price and time expiry till expiry. And so that's why call option writing is more lucrative for writers than for puts, just as a general rule. All right. Yes, ma'am.
So Wally says all you have to do is run the stream in reverse, since it's the opposite of the call.
Just watch me backwards.
Or DQ says just type the link in the browser in reverse, and then you'll have it.
There, I mean, not only do I give you advice as you know what you're paying for, you're getting this. You're also getting for free all of this other advice coming at you for no extra charge. I mean, it's just the benefits are incredible.
Absolutely. And a last question. One that I'm kind of loath for you to talk about because I don't believe in it.
Okay.
But they would like a little more explanation on margin accounts.
Oh, well, okay.
Don't do it.
Yeah, don't do it.
Well, you're anti-gen talk. Don't do it.
If you have 100 shares of GameStop at whatever it's trading at here, 190 a share. And you don't have a margin account, you just have a cash account only, and then you write a call option against your GameStop, and say you bring in $10 a share, and your GameStop goes up in price dramatically, a few days later, and you want to buy your calls back. If you have a cash account and you don't have any other cash in the account and you have no other securities in your account, you just have 100 shares of GameStop, you wrote a call against it for $950, and now the calls are at $14 each because the stock really took a shot, and you want to buy those calls back. You can't buy them back. You don't have enough money. So you have to send more money into the account and then buy the call back, and then you can turn around and you can either write another call at a higher exercise price, and maybe for the same price you just bought this one back at, but you might write a call option that is say you wrote a 220 call, then you bought it back, and now you want to write a 260 call, but it won't bring you in the $14 you just spent to get the call back. You have to leave the money in the account. And it might be money that you could use, you need for a mortgage payment or a grocery payment. I'm just assuming you're close to the edge. Or if you're doing it with 10 contracts, you wrote 10 calls for $9,500, and now you got to cough up $15,000 to buy them back. You don't have $15,000 to buy them back. You could theoretically just buy 5 back, write 5 new calls, buy 5 more back, and write the other, and then do it that way. But if you have a margin account, it gets really simple because the broker will lend you up to 50% value minimum on your GameStop shares. Theoretically, again, every brokerage house has its own rules. You have to check for yourself. But
and their own rates.
And their own, what they charge in interest, for any money you borrow, it's all different. Again, I'm just talking in generalities. If you need $15,000 to buy back calls that you wrote for $10,000, you're going to need 5,000 more that you haven't got right now. But you can borrow that $5,000 using your margin. You can just literally put the buy order in, and your broker will let you do it. And you owe the broker $5,000 against that position you just bought. Of course, your stock went up in price dramatically because that's why you would buy these calls back. Your stock just took off. Obviously, you can borrow way more money than you could have yesterday because your stock took off. In the meantime, you now turn around and write new call options for, again, whatever price you want to enter it at for however long you want to write it for. And maybe you will bring in the $15 that you just spent to buy these calls back. You bring in 15 from other calls that you write, and now it's neutral. You don't owe the broker any money. You're flat. You got your 100 shares. You got your 15. You got cash in the account, $15,000, and you're on your way. Or you got 10,000, I guess, in your account because you originally brought in 10,000 originally. But if you do not do anything and just wait for these shares to do what they're going to do, and they're going to go even higher, and they do go higher, you still owe the broker $5,000 on margin. They go higher, and now you write your contracts going forward, and they might be 330s or 350s, and you bring in the $15 or bring in $20 a share. You bring in more money than you owe to your broker. and now you have a cash balance in your account. So yeah, you paid interest for a week or so because you had a debit balance of $5,000 against a $25,000 position. So what? You're fine. Or $250,000 position, whatever number of shares we're talking about here. There are times though you might be sitting on a situation where you have 500 shares of GameStop. You wrote calls against it. You have enough money to buy 70 shares, but you want to get 100 shares so you can write a new additional contract. You buy the 100 shares you want. You owe the broker for 30 shares. You turn around and write a contract against those 100 shares you just acquired to add to the contracts you've already got outstanding, and that money comes in against the margin right away. So maybe you owe the broker $6,000 and you just brought in $2,000 in cash. You still owe the broker $4,000. But in 2 weeks from now, all the contracts expire, or 6 weeks from now, they all die worthless. And now you write brand new contracts again, you bring in a whole bunch of cash, and that takes care of the debit balance in your account, and you have a credit balance in your account now from the option proceeds the next time around. So you're carrying little debit balances from time to time to top up your position on your stock because you want to go from 500 shares to 600 to 700 to 800 and so on to write more contracts every time you do this. Sometimes you'll find that there's a dip in the market, you buy your calls back for super cheap, and you want to buy stock because it's on a dip. You borrow maybe 30% against your margin account, and you go from, say, 600 shares to 900 shares. And the stock pops up a little bit a week or so later, a couple days later, and now you're writing 9 contracts for $1,000 each. You're bringing in $9,000 against the money you borrowed when you bought on the dip to knock that balance down. And every time you roll over new contracts, you are bringing in more cash to knock down the balance of the margin to keep it nice and low until eventually you don't owe the broker anything. On the other hand, if the broker's only charging you 2 or 3% interest, each broker is different. You have to check your rates. You might find that for 2 or 3% interest, I don't mind carrying 10 or 20 or 30 grand in debit with my broker. I got extra stock here that I'm writing options on, which is way more than what the broker's charging me. He's charging me 4% interest. I'm bringing in 10% every 2 weeks on these contracts. I don't mind paying 4% a year, bringing in 10% every 2 weeks or every month. That's the strategy a lot of people employ as well.
Talk more about a margin call. When you get a margin call.
Well, a margin call is when the stock that you're holding as your primary asset, it goes down in value. You can't borrow as much money now on a lower priced asset. Now, if you owe 20 grand against an account that's worth 100 grand, the position at 100,000, the broker says to you, you can borrow up to 50,000. Right now you borrow 20. You have 30,000 spare change left over. You can borrow 30,000 more anytime you want. But if the position goes down to 80,000 in value, the most you can borrow now is $40,000, half. But you still owe 20. You used to have 20,000 or 30,000 excess. You're down to 20,000 excess from 30 to 20. Stock goes down even further and your account is down to 60,000 in value. You can only borrow 30 against it. You owe 30 against it, you're at the line. Any more droppage in your account value, you're going to have to cough up cash to carry it. This is the advantage of writing options though. If you can write call options against yours or put options, you're bringing option money in, premium money in, option money coming in, you are constantly bringing cash in against your debit balance. And every dollar you pay your account down by is a dollar more you can borrow down the road. So you bring in 10 grand on a bunch of calls you wrote, you go from 20,000 owing to 10,000 owing, your broker's loving you even more. You've got this much more room to buy more stock if you ever need to do so going forward. Okay. There you go. I'm getting the big nod of approval on the option question. There's a general overall view of that. Next week, Saturday and Sunday, we're going to do 2 more classes. And I'm looking at doing classes about aggressive option buying and aggressive option writing to really put the boots to the account. Some of you are interested in much more leveraged type strategies. I'll talk about that. For going forward beyond that, we're going to do classes about the stock market, just buying and selling strategies in the market, understanding a lot of the stock market, a lot of minutia in there, because as you know, every day that you watch me live, we're covering everything. I'm covering the planet to try to figure out what's going on and try to make it explainable to you in plain English. I'm also always open to suggestions. If any of you have some kind of classes you'd like to hear from me, send me a private email and say, hey, how about a class on this? Or how about a class on that? I'll be more than happy to look into that as well. But in the meantime, thank you for being here today and watching this class live with Jennifer and I here for Sunday, July the 11th, 2021. I hope you enjoyed it. I look forward to seeing you tomorrow morning. Back at it again as this market starts up again, and hopefully our shares will run up in price, and you guys will just get richer and richer and richer. Going forward, you'll be smarter option players, option writers. You understand the market a lot more. You've got a lot more confidence now about how these work. All of the firms that you deal with, all of the various platforms that you guys have on these, you're going to have to probably would be allowed to and will be able to look at videos on how to enter orders on your platforms for contracts, for options, whether to write or just to go long, calls and puts. There's a tremendous resources available there, apart from what I try to bring you. Hopefully that'll all make sense to you. But again, if you have any questions that you're not sure of, send me an email at brucefarmer@hotmail.com, or send me an email through the website. Those I've been getting as well, and we'll try to address those for you as best we can. Otherwise, I'll see you tomorrow on Monday. It's Monday morning, and we'll have some more fun then. In the meantime, stay healthy, stay cool, don't get overheated out there. Make sure you get your shots, and we'll catch up with you tomorrow morning at 8:30, or we'll catch up with you next Saturday for more classes with Uncle Bruce. Thank you all for joining me today. Have a wonderful evening. Thanks again, and we'll catch you later. Say bye, Jen.
Bye, Jen.
Oh, bye, Jen. All right, guys, we'll see you later. Bye for now.